Welcome to the Broken Pie Chart Podcast, episode 282. I'm your host, Derek Moore. Jay and I, once again, our schedules have not quite synced up. He'll be off this week. He'll be back next week or the week after that. All right. I know I've gotten some emails say we really like when you guys are on the air together and you're sort of going back and forth with some banter. We love it. I love it too. We'll be back, but obviously we want to keep doing the shows. A lot to talk about, though. Step back, aghast, get yourself off the floor. The S&P retraced 2.86% from its all-time high. Reached an all-time high on July 16th. Looks like right around 56.67 spot 20. Closed at 55.05. So that's what? Down 2.86%. The market retraced to prices that we haven't seen since July 2nd. All right. So to put that into perspective, the market is back where it was July 2nd. So look, I'm not saying the market's going to go back up from here. I'm not saying it's not going to go down. That's why we hedge. And as always, shoot me an email if you want to learn more about how we hedge for individual investors or how we run programs for advisors for their clients. Derek.Moore@ZegaInvestments.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to get correctly. Okay. So, I mean, I like to start off with just putting that in perspective, but there's some interesting things. And when I look at, and we know that some of the companies, and if you look at the charts of, for example, the semiconductors, and you look at some other companies that have definitely run up. And then on the other side, we had someone like UNH, United Healthcare, who had been a little bit sideways, been trending up higher. They have an earnings estimate and the stock rockets up. So there are stocks that are doing well. And, one of the things I like to, I sort of have a couple ETF symbols and index symbols that I like to look at. Because one of the things that the criticisms that we've heard is that this move, and certainly over the last, year or so, or since, I guess, probably since November, September of 23, is that it's all a few stocks. And this is why you index. This is why we love to buy the indexes. We buy it and we hedge. That's one of the foundational things that we do. And we buy it because an index is a living, breathing thing. I always tell this story, and I used to go around the country and get in front of crowds. I would ask this people, can you name me who the number one weighted stock in the triple Qs, the QQQ, the NASDAQ 100 index was back in March of 2000? And I kind of pause and people say, well, was it Apple? No, it wasn't Apple. Was it Microsoft? Nope. No, Microsoft was had a pretty healthy weight. Wasn't Microsoft. You're kind of going around. No one ever gets it. Sirius Satellite Radio was the number one market weighted company in March of 2000 in the NASDAQ 100 index. Think about that. And when you look back then, I mean, we've done this before. It's different now with regard to, and again, I'm not saying the market's going to go up or down from here. That's why we hedge. It's when we buy and we hedge, because it lets you stay invested, but at the same time have protection to the downside. And those strategies are very popular. So, but the reason I bring this up is look at the cash flows, look at the earnings. Back then in the late 90s, early 2000s, you had companies that had negative earnings and were very highly weighted. I went back, and if I ever, I don't remember which episode it was. And I know some people have asked me, how is it that you're always like, hey, I can't just find the link very easily. I should have started, this is episode 282. I should have started like an index or just a list every time and of which episodes talked about what. I never did it. I mean, we've been running this for a couple of years now. But if I find it, I think I did a deep dive on that. And, I went back and I looked at the earnings and the cash flows of some of those companies that were in the top 10 in the NASDAQ 100, and just not the same. But I'll give you a couple things that I like to look at. And we know the S&P 500 index, if we look at over the last, let's say, since the end of June. So now we're in Q3. What's the performance, the total return of the S&P 500 index? Okay, it's 0.6%. 0.6%. Okay. And then I look at something like VXF, Victory X-Ray Frank. And that is it's a Vanguard, it's an extended markets index. So if you think about, I think the way they describe it is, what's the largest 2,000 companies? And then they chop off the top five, the S&P 500 companies. What you have is the remaining. That's up 4.55% total return since the end of June. And you look at something like RSP, which is the US equal weighted ETF. And that's everything. It's basically the S&P 500, but everything's equal weight instead of market cap weighted. That's up 3.34%. You look at something like EFA, which is developed markets and mainly international, but it's a lot Eurocentric, plus 1.35%. EEM, emerging markets, that ETF is down. It's up. Total return basis, 0.12%. So as the reason why I bring that up, and then you sort of look at these same indices or these same ETFs or indexes, and you look at it, since the close last Friday to the close this Friday, which was the 19th, the market's down, the total return of the S&P 500 minus 1.95%. Emerging markets is just under negative 4%. Developed markets minus 2.51. But then you look at the Vanguard extended market ETF plus 0.27 and the equal weighted minus 0.08. So all that said is just one of the things. I guess the question was, it's only these stocks. It's only these stocks. Yeah, absolutely. NVIDIA, Microsoft, all the big companies and all big tech, those have been rallying. We know the semiconductors have had an unbelievable run. But there's stuff below the surface. There are companies that are actually going up, even when some of the big companies are down. And I guess the question is the non-big tech, the biggest of the big tech, if they do take a breather, and they don't necessarily have to go down, they just have to go side. Again, I don't know what's going to happen. That's why we hedge. But the question is, are some of these other companies who have underperformed relative to some of these bigger names, do they sort of start to get a bid? And I think you can see that. I mean, even though the market, the S&P 500 was down more than those, and some of those are up. So something to keep in mind as we sort of go forward. And those, it's no secret that those companies on a relative basis have been, waiting a little bit. I think we also saw it with small caps. Small caps certainly get a bid. And this is a chart from, let's see, this is EPFR. I don't know who that is, but I saw it. It was passed on to me. Who put this out? It was probably on Twitter. Isabel Net posted this. Okay. Weekly flows to U.S. small cap funds versus the 4-week moving average. All right. So you can't see the chart, but basically what it says is this is going back to 2007. And this is billions of dollars. Small caps see second largest weekly inflow ever. And this goes back to is this the end of 2007 or the beginning of 2008? I don't know. It's a little tough to see. So, yeah, small caps, and that's the idea of, maybe the Fed's going to cut, and small caps, this is the theory that those companies are disproportionately will benefit from lower rates. Because, Apple and a lot of those big companies, they sort of, they have their debt already established, and they can get better rates than some of these other companies. Anyway, and also on a relative basis, small caps were certainly underperforming relative to the S&P 500. So seeing some of those other companies start to get a bid. So, all right, so something we'll watch. And again, if you want to sort of watch at home and get a little more idea, you're preferred trading platform, whatever it is, like punch in SPY, punch in RSP, VXF, Victory X-Ray Frank, and EEM, EFA, all the symbols. It's just good to sort of see on a relative basis. IWM, which is the Russell 2000 ETF, a couple of those. The other thing that I found interesting is, so there's been a lot of talk about the high yield spread. High yield spreads are really, really tight. That's what you keep hearing. And the high yield spread basically says, let's look at the yield. So basically the yield to maturity or the yield to worst on high yield bonds. And then you compare that to US Treasuries. So let's say, here, I'll just give you an easy example. Let's say the Treasuries are yielding yield to maturity of 5% and high yield bonds are yield to maturity of 8%. You would say the spread, the high yield spread is 3% or 300 basis points. So basically, and by the way, if you don't know what basis points are, 1% is equal to 100 basis points. So if rates, let's say rates or the spread went from, in my example, 3% to 2.99, you would say it dropped a BIP, 1 basis point. Okay. Anyway, set that aside. So you've been hearing that a lot. And that's true. I mean, high yield spreads had gotten lower, the lowest they've been since probably, I don't know, April or maybe May of this year. They were low and at the end of March. And so the reason I bring that up is one of the things that I watch is I do look at spreads. And because when you have a drawdown in markets, and if it's a concern about credit, meaning credit, the ability for companies to pay back their loans, bonds, when they issue bonds, they are a loan, they pay interest on it. If there's sort of cracks in the credit markets, or if there's a worry about, it's anyway, I don't want to get too far down the path there. But when spreads don't necessarily, just because spreads are tight doesn't mean they have to blow out. Meaning by blow out, and let me explain this. So let's say the high yield spread is right around, it's actually probably about 3.1 right now, 3.1%. So high yield is yield to maturity, 3.1% above what treasuries are getting. The high yield spread can change if treasuries, let's say, were to go down and yields went up, or just interest rates sort of bleed in there. So treasury yields can go up, high yield yields can go up, high yield yields can go down, you have these two pieces. It's a relative calculation. And the reason why we say spreads blow out when there's certainly a credit event or upset in the markets is the idea that people are selling high yield bonds. And a yield to maturity is a calculation that's derived from, if you bought a bond, let's assume it doesn't default, and you get, at maturity, you get $100 back or $1,000 per bond back. It matures at 100. And so you have, when bonds sell off, the distance between where you buy it and where they mature at, plus any coupon, that's your total yield. All right, I'm spending too much time on the high yield spread. But I bring that up because they actually didn't move too much this week. And I always sort of watch that, and it's one of those things, well, markets sold off a little bit, but the high yield spread really didn't move. What's that saying? I don't know yet. We'll know when we know. But sometimes it's one of the two is wrong. And you could say, well, the market got a little ahead itself with pulling back, but high yield spreads didn't move. And they actually, I think, were positive for the week, high yield bonds. Or it's, hey, high yield just didn't catch up yet. So watch that. That's something I watch. I'll put a link in the show notes where you can actually see at the Federal Reserve Bank of St. Louis. They have a lot of free stuff that's there. And they have a chart of the high yield spread. Okay. So let's talk a little about where do we go next here? CrowdStrike. So CrowdStrike is another example of volatility inherent in single names. And we do a lot of work with managing concentrated stock positions. And that's sort of an industry term, especially in the registered investment advisory area, where you'll see former executives of companies, or maybe people just have a lot of stock in only a few names. So imagine you work for a company and you have all the stock and you have a very, very low cost basis, meaning you have it at a very low, you sort of got the stock at a very low price and the stock's run up. And so if you were to sell it, you'd have tax implications. So it's one of those things. People a lot of times know they should diversify, but they feel stuck a little bit. So we manage concentrated stock positions, and we hedge it. Sometimes we just hedge it. Sometimes we generate income only. Other times we generate income to help pay for the hedges. And if you want more information about that, by all means, reach out. But we know that single stocks are more volatile than indexes. And CrowdStrike. So CrowdStrike probably, I'm not going to go through it because you probably heard it all already. It looked like they had an update that caused an issue. And I won't pretend to know, to delve into the details on this. But basically, they had some issue and it caused issues for people running Windows or Microsoft and stuff in the cloud. And as they basically, their news wire said they issued a statement. They said it's not a cyber attack, so that's good. And they said it experienced a significant decline in its stock price following an incident involving a company update that affected products from Microsoft and resulted in widespread outages across various key sectors globally. I know some of the financial firms were affected. I heard airlines, any sort of number of things. So the stock is off 22.23% off its high. Its high was really, when did it reach its high? Very end of June, early July. But it went down, significantly yesterday. And this is a good example of the inherent risk in single stocks. And with options, you're really able to hedge a lot of that stuff. So but single stocks have more volatility than overall stocks. I wrote a paper along with Jay. I'll put a link to it in the show notes. And we actually wrote a whole paper about single stock risk and managing single stock risk. And I'd urge you to check that out. There's a shorter version and there's a longer version. We show charts, but one of the things we look at there is the standard deviation of the volatility of single stocks versus an index. And it's significantly higher, not a surprise. So I'll put that in the show notes. You can check that out. And hopefully you enjoy that. Let me know how you like it, by the way. We wrote that a couple of years ago. Actually, it's more than a couple of years ago, but that's been on there. We are in earnings season right now. And when you think about earnings, we're starting, this week, there were names last week too. Netflix came out last week. Netflix actually had a pretty good report. But this week, Tesla, Tuesday, the 23rd, they are scheduled after the close. Alphabet/Google, they are after the close. Visa, and Visa is not necessarily a stock that, it's not one of the glamour stocks like a Tesla or a Google, but it's good information because, most people these days pay with a credit card, and so it's a good barometer of the economy. And looking later in the week, you have everything from, American Airlines, Chipotle's Wednesday after the close, Spotify before the open Tuesday, Verizon before the open Monday. So this usually comes out on Sundays. So earnings season is just really a really interesting time because it's one of the 4 times a year you hear directly from the companies and you get to see what their books look like. And often the CEOs, they'll give forward guidance. Forward guidance just means, hey, I think we project our revenues of X or Y and their net income, and they tell you a little bit about what's going on. So it's a pretty full board. I know I only mentioned a few of those, but Coca-Cola, UPS, who else is that? Honeywell, AstraZeneca, Bristol Myers Squibb, BMY. All right. So a couple of those, keep an eye on. I think it's the following week is, I don't want to say for sure because I don't have the calendar up. I had it up and then I closed it. And I'm always interested too. There's some companies that I'll admit that you have to be humble sometimes. There's some companies that I see are reporting earnings and I'm like, really? I didn't know they were a public company. Okay, so let's kind of move on from there. The other thing I wanted to talk about, and it's the VIX I definitely need to talk about a little bit, and volatility. We're an option-centric firm, hedging and generating income, so I want to speak about that. I will mention very quickly too, I'm starting to get people pass me stuff around the yield curve. And the idea is that you have a yield curve inversion, meaning short rates are greater than longer rates in the bond market. They look at U.S. Treasuries and 2s and 10s. So 2s and 10s, where the 2-year yield versus the 10-year yield, it actually went positive, meaning the 10-year yield was greater than the 2-year yield. It kind of popped its head above positive. Whether it stays there or not, who knows? Honestly, I didn't look at it Friday, but it's just something to take a look at. And the idea is that you don't get the recession when it's inverted. It's when it uninverts, then you get the recession. So, and the theory here is that the Fed starts to lower short-term rates. This actually is not the Cam Harvey. The initial paper dealt with the 3-month yields against longer term yields, not 2s and 10s. But this is often quoted. I've seen 5s and 10s is actually an interesting one that I think I'm the only one who watches that. But I don't know what to do with this. You don't have to have a recession every time, and a recession at the same time is completely possible. There's little guarantees in finance and in markets, but at some point we will have another recession. Whether recession is a bad one, like 2008, or it's kind of a mild one, like the early 90s, I don't know. But this is why, I'm reticent. Sometimes I realize we would get many more listeners if all me and Jay did was come on here and be negative and say the sky is falling. And some people have criticized us for like, why are you guys sort of positive? Here's the thing. When you hedge the downside, you're not sort of trying to pick the absolute tops and bottoms of market. You want to stay involved in the market, but you want to have some protection, whether it's a buffer, like we do with our Zega buffered investment growth strategies, or our buy and hedge complex where we have hedges in place. So I don't know what to do with this, but I can tell you that a little bit of volatility, or should I say some seasonality, is possible in the VIX. And I looked at a chart. Who's this from? This source is Top Down Charts and LSEG. I'm not sure who those folks are, but the chart they put out, they said the average CBOE VIX index from 1990 to 2023, and they have another line that excludes 08 and 20. And I guess they wanted to take those out because they said, well, those are very volatile times. And then 224. And if Jay were here, he hates these charts. He hates when you take like prior periods or averages and then you draw where you are so far. But I will tell you, and we see this, a lot of times volatility dips in the summer. And as you get to September, October, you start to see a little bit of seasonality where volatility comes up. Now we have this little thing, an election that's coming up. It's not new news, but for any of you, hopefully, unless you've been living under a rock. And we've been seeing it for a while that if you were to buy, so when you think about the VIX index is not tradable. The VIX index you see on TV, it's sort of the cash of the spot. It's not tradable. You can't trade that. It's just an index. It looks at the 30-day, looks at about 30-day time frame, looks at all the options in the chain of the SPX, and it uses the prices to inform what the implied volatility levels are. Okay. You can't trade it though, but you can trade. And by the way, don't start doing this. Please don't. Please don't. Start trading VIX futures. And VIX futures, there's an active contract, which is sort of the near month or more near month. But you could buy a November VIX contract. You could buy or you could short it too. You could do any of these things. And when you buy options on VIX, you're actually not buying it on the one you see on TV. You're buying those or selling those on VIX futures. So it's a little more complicated. That's why I really don't want you trading VIX. So, but we see it though. And the price of the VIX future more near in, especially before last week, it was pretty low. The VIX future in October and into November, there was sort of this little kink in the VIX curve where it's higher. And Jay and I have talked about this before, and it's why, a lot of people say, well, I'm going to buy VIX because I think come October, you might see some volatility. Well, which VIX are you buying? When you're buying options, which VIX future are you buying those against? So it's a little more complicated. But it wouldn't be surprising on a seasonality basis, and we've seen this before, that you could see the VIX have a little bit of a move higher here. I don't know if that's the case. We did see the VIX go higher this week. It wasn't crazy high. It was, if I look at the VIX index and I look at where it went this week, it got up to, a high of, where was this? I think intraday was up over 17. And if I think about, it was above 19, didn't crest 20, but it was above 19 in April. I think the high it got Friday was something like 17, 20, right around there. So, some seasonality is to be expected. The other thing we saw is that the VVIX, which we watch, which is sort of like without going into detail on it right now, it's sort of the volatility on the VIX options. So the volatility of the volatility. And, that crested 101.71. We sort of mentioned there's an 80 level where below 80 is sort of tends to be, where low volatility begets more low volatility and vice versa. It doesn't mean markets are crashing or anything like that, but this is sort of, VIX was really mellow, and it's not surprising that we see a little bit of an uptick here. So, all right. So what does this mean for investors taking it back? I would say, yeah, the markets pulled back. They pulled back to levels not seen since July 2nd. It looks like there's a broadening out across more names in the market. And I went through the relative performance. And I'm not saying that you should buy those or not buy those. That's sort of why you index, because the theory is if there's other companies that sort of rise up and do really well, their market caps will get bigger, and inherently you'll own more of those as they're going up. And it's that's why I've made the case before that in some ways indexing is a little bit like trend following. It's not trend following. Okay, I want to make that clear. But it's the idea is that the stuff that's going up, you sort of start to own more of it. And the stuff that's going down, you don't own as much of it if you own an index. So just kind of go through there. All right. Do send me emails, derek.moore@segainvestments.com. I forget the person's name, but the high yield spread is something. I got a question on that. They said, and really it was the question. I think I answered it, but the question was, when they say spreads are going to blow out, or they say the high yield spread is really narrow, what does that mean? So we kind of went through that. So ask your questions. We'll try and bring those up, and hopefully everyone has a good weekend. Oh, I'm still watching Dexter, which is sort of an interesting show, and I think I'm in season 2 right now. I looked and I said, how many seasons are there? It looks like there's like 8 seasons. So apparently this is going to be a time investment. So it's going to take me a bit to go through those. And then I'm going to rewatch the original Twisters. It was on the other day and I started to watch it. Twister. So Twisters is the new one, but Twister was, what was that? 96, I think. I think it was 96. And I liked the original one. So I don't know. I have it on my list and I can't say I've been to the movies lately, but this looks like maybe that one's an interesting one to go to. So more on that. And that's it. That's it. We're done. I'll come back next week. Maybe just me, maybe Jay and I. And I promise the audience, once our schedules sort of get a little less busy, whenever that is, we'll be back on, because I do enjoy the banter back and forth, and I know you all do as well. But we still want to do shows. We still want to give you some info. All right, that's it. We'll come back next week, and you'll see how wrong I was on everything I talked this week. See you, everyone.